Private equity giant Blackstone out with first quarter results a short time ago. We want to get more on this quarterly performance, tariffs, markets, and so much more. I want to bring in Jon Gray, President and Chief Operating Officer of the Blackstone Group. There's about 1,000,001 things that we want to talk to you about, John, and boy, are you right in the center of it all. Why don't we talk first, though, about this earnings report? It was good on a relative basis to where the world is, but of course the world is a complicated place right now. How do you look at it?
Well, I'll start with the quarter, Andrew. Great to be with you as always. We had a terrific quarter. We had inflows of $62 billion, which was the most in nearly 3 years. We delivered in all our major strategies in terms of positive performance, despite the turbulence out there. That is our true north, delivering for our clients. And what's really exciting is we have a number of big areas: infrastructure, private wealth, private credit. All of those areas have a ton of momentum. So we realize we're heading into a more difficult period, but we're on a very firm foundation.
You put a lot of money to work, even in the last quarter. So what is your thinking about where we really are?
Well, in terms of where we are today, we're obviously facing a more difficult environment. Everything changed on April 2nd. I think what we need is a little bit of perspective here. There's certainly a lot of pressure in parts of the economy where you're focused on input costs, manufacturers, retailers. There's now also, of course, market dislocation, which you guys see: M&A activity, IPO activity, spreads going wider. And then there's the risk of this moving into the broader economy and there being more of a slowdown here. And all of these obviously create real challenges. But what I would say is, if you want to have a little bit of optimism in the face of all this, is it's not like crises in the past where we had the global financial crisis and we had trillions of dollars of excess debt that was out there. It's not COVID where we were all forced to go home and be in our pajamas and shut down big portions of the economy. This is policy-induced stress, and It can change very quickly. So I think this tariff diplomacy can move. And I think as investors, you've got to recognize that certainly the faster it's resolved, the better. So
do you say to yourself, I need to invest into this uncertainty? I look at the last quarter, your deployment of capital year over year was up 48%. The other question would be, should have you waited for this moment, given that the world has turned? This was $36 billion that you put to work.
Well, we obviously, our firm continues to grow, but we look at things on a long-term basis. And so we had the opportunity to buy some terrific businesses in the quarter. We committed to buy one of the biggest marina businesses in the United States called Safe Harbor for nearly $6 billion. Our private credit business continues to serve both non-investment grade and investment grade borrowers. There's dislocation in real estate. We like the moment of investing in that area as well. And yes, today, as prices reset, we've got $177 billion of dry powder. And we love having that capital. And we've started to put some of that to work on the screen as spreads have gapped out and there's some discounted debt. We're looking at public equities. And I think the reason for our optimism, it's not that we don't recognize we're heading into a more difficult period, but it's because we're long-term investors. And if you think about what really drives value, it's what's happening long-term in some of these huge trends we focused on. So if you think about technology, there is amazing innovation happening. Andy Jassy said last week that it's the reinvention of everything. Right. If you think about it in terms of relative to, say, the horse and buggy going to a car, I think that's what you're going to see from AI, from the data centers, from the power supporting it. So, yes, it's a difficult period. You have to recognize that, particularly in the challenged sectors. But if you're thinking about being a longer-term investor, when prices come down, that creates the opportunity to invest.
You're a real estate guy early on in your career. Now you oversee all of it. We've talked a lot about BREIT, your REIT product. The University of California CIO says the real estate recovery, quote, ain't happening. Are you in agreement with him?
I would say that the real estate recovery is moving forward. What I would say about that is when we talked about it a year ago, we said things were bottoming. We said it wouldn't be a V-shaped recovery, but it was all sort of falling into place, and we see that. What happens in a real estate recovery is prices fall. That's occurred. And then you see a real reduction in new supply. That's happened. Interestingly, the tariffs will make building even harder, so there'll be less new supply. And so just like the early 90s, we're in that period of time where the recovery's beginning after the financial crisis. The same sort of thing is happening. That's why you see us deploying capital. Buying hard assets at a discount at this point in the cycle makes a ton of sense to us.
Are there businesses that you own that are going to be materially impacted by the tariffs? Is there anything you plan to do about it, and what kind of impact it will have? And are there any assets that in this new environment you would say to yourself, either one of two things: we actually are going to reshore back into manufacturing from a portfolio company back in the U.S., or we're going to try to divest certain companies because, you know what, this new world is too complicated for it?
Well, we've got a relatively limited number of businesses directly in those supply chain areas, but we have some. And in those businesses, they've got to think about what they're going to do around their input costs, how they can potentially go to other locations for sourcing, how they can think about pricing, but it clearly has an impact. And that's where the greatest stress is in the economy. And so, yes, you want to focus as an investor on the things that are directly in the line of fire, and you want to make sure those companies are reacting. We were spending a bunch of time anticipating tariffs, so some of the companies have prepared, but nevertheless, this is a challenge for those businesses. In terms of going forward, I think you do have to be mindful of what does this mean for certain businesses. But a lot of what we own is less in this directly impacted area. So if you own software businesses or healthcare businesses, business services, infrastructure assets, there's probably less of an impact. And so, yes, it matters where you invest, but I ultimately believe there will be some settlement here. This tariff diplomacy is going to land. I was encouraged by what the Treasury Secretary said earlier this week, that they're making good progress with trading partners. I do believe there's going to be a resolution here, and I think you have to recognize that, even if there's going to be some pain over the next 6 months.